If you don't know me, so my name is Randall. If you don't know, I am a commercial investor. I invest in heavy value add self storage facilities. So tonight's conversation is going to entice me as well. But we'll open the floor and see who's got what. If we have any haves, needs, or wants within the group, go ahead and raise your hand on the bottom, and we'll go from there. If I don't see any hand raises, I will do an introduction of tonight's speaker. Don't see any hands being raised, so we will go in. All right. So tonight's speaker, we have Ryan. I don't know how to pronounce your last name. Gavigan. You're muted right now, Ryan. And he is a broker with Marcus and Millichap, and he focuses on the multifamily housing group. So he's going to share with us how we can benefit from a broker and how to build the investor broker relationship. And take notes, ask questions. I'll be monitoring the chat for questions we have, and we'll kind of go from there. Ryan, take it away. Ryan, we can't hear you, buddy.
You're not muted, but we still can't hear you.
Yeah, you're not muted, but we can't hear you. Still nothing. Can you hear us? Give me a head nod if you can hear us. Okay.
What, you guys, you sure you don't want to revisit who's got what while he's getting his stuff together there? Anyone
I know.
looking for anything? You have a property you're trying to sell? You need a contractor? You need a roofer?
Hey y'all, this is Sal Filardi coming to you down from Pinehurst, North Carolina. Relatively speaking, rookie investor, like 3 maybe projects that I've worked on. I've got maybe not a who's got what, but maybe just something to share fun that I learned this week.
Absolutely, go for it. And welcome, by the way. Is this your first meeting with us?
Yeah, first NC RIA event. I've been getting the emails for a while, but finally made the time, and glad to be here. Thank you.
Well, welcome, and thanks for being here. And heck yeah, share anything you'd like. Good news, got a new baby, new grandbaby. We'd love to hear anything.
Oh, I've got a ton of great stories like that, but I'm going to focus on the real estate one for the moment. Let me turn this on because that is more polite to do it that way. Cheese. Yeah, so if you have any military investor friends, I just learned that if the military gives you orders to a different duty station, thus forcing you to leave your primary residence, your window for needing to conduct a 1031 exchange is significantly extended to 10 to 15 years based on your circumstances. So I was worried and working through the widgets of how to do a 1031. And then I got into the tax code and the IRS website and figured out that that is not necessary. So super stoked to be saving the hassle and the fees, and especially super stoked to not be restricted to a 6-month window to try and reinvest the market value of the house that I'm selling in Texas. So yeah, there's my fun thing to share.
That's a great share, Sal. Thank you so much. That's a great share.
Especially being, in North Carolina, close to a military installation. That is an awesome tip.
Yeah, for sure. But we have a lot of our members invest in Fayetteville, and we even have a Fayetteville subgroup. So if anybody is interested in what Sal just said, and you want to do some investing in Fayetteville, because by the way, there's some good darn deals down there. Do look at our calendar and attend that Fayetteville meeting. It's just an hour, or it's less than an hour from my house, probably an hour from Raleigh. And the subgroup leader there, Cheryl Gleason, she's just awesome. Ryan, did you get it sorted? Nope.
Hold on. He dialed in with his phone.
I know. I let him in with the phone, but I'm still not hearing anything.
He's got to unmute.
Well, he's probably needs to stay muted if he's going to talk on his phone.
Yeah, that's what I'm saying. He's got to.
You can hear me now?
Yeah.
Yes, we can hear you now.
Okay, perfect.
Can you turn down your computer though?
Yeah. Turn down your sound on your computer.
I've got my computer.
There you go. You
All
got
right,
it.
is that better?
Yep.
Yes, that's much better. All right,
Perfect.
so there we go. Ryan, we can see you in the little video box, but when you talk, your phone comes up. So I'm going to pull up the slides.
Perfect.
I'm going to share my screen, and when you get ready to, to talk, just tell me. Next slide.
Yes, sir, we'll do.
All righty, there you go. Can you see those?
All right, perfect. All right, well, thank you, everybody. Sorry for the technical difficulties. My name is Ryan Gavgan. I'm a multifamily broker, like Randall said, here in the Raleigh office for Marcus and Millichap as part of the McDaniel team. So I focus mainly on multifamily assets as well as mobile home parks, as well as development sites, mixed-use development as well. So the point of tonight's meeting is to get you guys, better understanding of how to formulate your team, how to get out in front of brokers, how to get on their deal flow list, and then some common practices that I've kind of taught my clients that are getting into the space on what the best practices is going forward, on how to succeed in this business, and to put you in position to not only win deals, but also make money on those deals. So with that, we're going to talk about your team, so your centers of influence, who are going to be the key players to not only get you into the deal, but know how to make money while you're in the deal, and then how to exit the deal. Next is finding such brokers. Depending on what asset class you're looking for, it's always good to find a specialist in that class, and I'll tell you different ways in order to do so. Three, since the market is very much the topic of conversation, especially in my world, and I'm sure in your world as well. I just wanted to talk about the current rates and how that's affecting prices, as well as deals, as well as messing with timing, and seeing a lot of retrades right now due to the fluctuation in the markets. And then four, looking at the difference between residential and commercial best practices going forward, and then bringing it all together. And I've got my partner, Scott Bell, that will run through a deal together with you guys as far as the scope of the deal, how to get into the deal, how to make money, and then how to exit. But with that, we can go ahead and switch over to the next slide, please. All right, perfect. So key players, your broker, you're going to want to find somebody that is a specialist in a given market. For instance, myself and Scott, we only focus on multifamily assets, mobile home parks, as well as development deals. Your lender, which is very key in this market, is not only getting ahead of the curve. So when you do, if and when, find a deal that you like, that you already have your lending lined up so that you can put yourself in premier position to not only win the deal, but also make sure you can close the deal. Because when working with brokers such as myself, we always look for folks that are well organized, have a good team behind them, and what is their the opportunity for probability going to get the deal across the goal line. And with that, a good closing attorney, someone that can deal with all the obstacles and the fluctuations in this market due to retrades or environmental aspects, dealing with a deal in Eden, North Carolina, which there was some petroleum found in a phase one, and being able to navigate those waters through going back to the phase one, reviewing what they noted, then getting the phase two out there. They had to drill holes to get a soil sample. Then the soil sample was ruined because it had too much water in the sample. And then it came back with actual little bit of petroleum in the sample. So it was all due to a
a service facility on the above this asset. So now the next step is getting a vapor testing done. So not only have my client and I had to go outside the closing attorney, but now had to hire an environmental attorney to navigate these waters, to not only negotiate with the environmental folks, but also find the best course of the way forward to get the deal done. And then also property manager is key, because especially with out-of-state ownership, you're putting a lot of not only pressure, but faith in the property manager's hands, because they're going to be the ones operating your business on a daily basis. And the way that things are moving, you want to make sure they're not already meeting, but exceeding where rental rates are going, and making sure that you can put more money in your pocket. Also, from an expense side, a lot of these local property managers like to, for lack of a better term, charge you for every little thing. So you want to make sure you're not only making the property manager honest, but also looking at 3 or 4 different options to give you the best, partner in the deal that not only is local to the asset. So typically you want somebody that already has an office in that area where you're going to be investing, and then also has experience in that area as well. So always want to look at track record. Just also ask for referrals from other clients that have similar assets in that class as well. And then other third parties like environmental appraisers, any other third parties you might run into, surveyors are very bogged down right now. But that is the folks that you want to put together a team, so that when you go to put a deal in or put a LOI in to get yourself in perfect position, you want to make sure you've crossed all your T's, dot all your I's, and that everybody on your team is ready to capitalize if you do win the deal. Next slide, please. So as far as finding a real estate broker, so you want to find someone that specializes in a given market. Slight little plug here for Marks and Millichap, our firm. We have over 2,200 agents across 80 offices, both the United States and Canada. Every single one of us focuses on a given product type. So I play in the multifamily, mobile home park space all day long, as opposed to if you have something like self-storage, like Randall referred to, as well as net lease, you're going to want a self-storage broker, because he's the one that is going to be there, has all the deal flow, as opposed to a generalist who's going to have a lot of different deals, but he's going to be the master of none. So you want to be the guy that knows the market, masters the market, and then therefore he can not only feed you off-market deals, but you also can get on his deal flow list. So making sure you do the correct research, whether it's, we'd be happy to refer you to any Marks and Millichap agents if you're not interested in multifamily investing or mobile home parks. We'd be happy to point you in the right direction, and we can get you on all their deal serve or deal sheets, so that you're getting every deal that comes to market. And then also reaching out to them, putting a face to the name, shaking hands, having coffee, lunch, adult beverages, whatever your fancy is, but making sure you get in front of them so that they know who you are, you build rapport, you show them your propensity to get deals done, and then you're building that relationship. This is, whether you like it or not, real estate is about relationships. And the more relationships you have, the stronger you're going to do. So that's relationship with your lender, your attorney, your broker. All those different things are going to help you succeed in this business. So those are the certain things that I would focus on when choosing your broker. Next slide, please. So the big old elephant in the room is cap rates and interest rates, and where is that going, and how does that affect your ability to get into deals? So as rates are moving, so is your ability to purchase deals, your leverage. We always want to look at debt coverage ratio. So what is that over the expense to what you're paying for the deal? And you want to make sure you're not only making money, but you're not, over leveraging yourself. So for instance, the SOFR, which is mostly based upon bridge debt, which a lot of these investors from multifamily side have been getting into bridge debt so they can do their value add, and then they go ahead and refinance into more permanent debt. Well, unfortunately, the SOFR, which is directly coordinated to bridge debt, has moved 75 basis points in the last 6 months. It didn't move in the last 2 years. So when you're going into a deal, for instance, we have a deal here in Raleigh where it's right around, low 4 cap, and bridge debt is now in 5.5 to 6 range. Well, a lot of investors are going to be like, well, Ryan, how am I going to cover that, $100 to $200 basis point spread? Because I'm going into the deal negative. Well, then that's how you look at different deals on how you get into it. Maybe there's a different, maybe you go agency debt instead, where you can get, a couple years of IO so that you can free up cash flow to do those value add opportunities, whether that's refurbishing the outside, putting a new roof on, painting the exterior, putting a nice little curb appeal around it. And then also where the money's really made is investing in the interior upgrade so that you can push those rents up to market, whether that's LVP, whether that's, paint or stainless steel appliances, granite countertops are all the rage, the agreeable gray on the paint, and making it more of a modern feel. So if you, for instance, have a B-class property and you want to take it up to that A range, well, you don't have the amenities to compete with the A's, but you have the same finishes as the A's. Well, if you float underneath them by $200 or $300, then you set yourself up or position yourself to be the economic alternative, especially when a lot like during COVID, where we saw kind of a blip in the radar screen. Everybody's, your crystal ball is as good as mine, but we're headed towards some sort of correction, and we're already starting to feel that turbulence right now. So in the multifamily space, typically the A's get hurt first, because those are the folks that are like, well, I don't know if I can spend $2,500 a month on rent. Maybe it'd be better to spend, $1,500 to $1,800. I don't get the pool, I don't get the gym, but I'm right down the street from this Class A where it was. Most folks, they've done studies that 15% of tenants actually use the actual amenities. It's more of a sales pitch to get them into the deal and get them in signed up for the 12 or 13-month or even 6-month lease. On a short-term basis, you're typically going to see, a more of a premium on those rents. So all that to say is that what is the best, mitigator for interest rate risk? Well, that's passive investing or commercial assets that have rent raises every 6 to 12 months, so that you can outpace the rise of interest rates in this environment. So if you position yourself in a market like Raleigh, where we've had 22% rent growth over the past year, 12 months. So if you have interest rate creep of like 1%, well, if you're pushing rents by 20 or 30%, then you're still in the clear. Now, if you're going in with that bridge debt, and then you say, all right, I'm going to do this value add, I'm going to take rents from $800 to $1,300, well, that's close to 50 to 60% bump, then you're going to outpace those spreads that you were worried about when you got into the deal. So it's not how you get into the deal, it's how you make money and then how you exit. So obviously a lot of different lending options. This is where your lender is going to come in very handy. So he's going to look at how much money you have liquid right now. It's always good if you're trying to get into a deal to reach out to other folks that have had a lot of success. I'm sure there's a lot of folks in this group that already have multiple assets and have a track record that you could say, pick their brain on, or say, do you want to be an LP or a GP on this deal, where they are going to invest their money but put their name behind it so that you can essentially qualify for debt that you wouldn't necessarily qualify for, and be able to get into a deal that you wouldn't necessarily be able to buy, but by leveraging their experience, their bankroll, and then you by doing your sweat equity and then doing all the other back office work and due diligence to get into the deal, because they're going to ask you a couple things. All right, what's the upside? How do we get into the deal? How do we make money? And how do we exit? So making sure you team up with someone like that if you don't have enough dry powder, as they say, to get into an asset, or finding other creative ways. We've seen not only the private equity side, but preferred equity is also something you can look at. There's a lot of syndicators out there that need to hit certain parameters on a cap rate basis and cash on cash, because typically they skim 10 to 20% off the top, but then investors still want to see at least 8 to 10% cash on cash returns. Now there's some other REITs or institutional money where they're happy with those 2 to 4 to 5% returns. But I don't know about you, I'd like to see double-digit returns on my investments. So you want to make sure you have the right lender in place. If that lender doesn't provide the options you have, then that's when you start to expand your database and also utilize the team here at NC RIA, figure out who the best lender is, also reaching out to myself or my partner Scott, who's on the call as well, on finding who the best lender is. Now, these local banks have been very aggressive. So making sure you also, when you make the banks compete, you win. So making sure you get 2 or 3 different quotes and then holding their feet to the fire, especially with rates moving as much as they are, you want to be able to hold not only them honest, but also these other groups to figure out who's going to give you the best rate and terms to maximize your dollars. Next slide, please. So where to start when getting into your first investment? Like I said, just to reiterate, finding the best bank or institutional option, whether that's, agency debt, bridge debt, or just typical conventional bank financing. Typically with banks here that I've noticed, especially during COVID, a lot of banks, especially agencies, which is Fannie and Freddie, for those of you who don't know, that's a federal backed mortgage. They typically give you very nice rates. It's typically about 100 basis points below where a bank's going to offer you. Plus they give you 30-year amortization and a couple years of IO to facilitate you doing any upgrades to the property. Now, when COVID happened, they asked for a significant amount of money to be put in reserves in case, for lack of a better term, stuff hit the fan, so that you had a slush fund to go to in case, tenants started leaving, they couldn't pay their rent. How are you going to pay your mortgage? So in other words, Fannie and Freddie was not an option for a lot of these deals. So then we went to, a lot of different local and community banks, and they got very aggressive and actually ended up matching a lot of the terms that you would see in agency. And you don't have any prepayments. You were able to burn that off. A lot of this is yield maintenance, which is affected by the cap rate and interest rates, because as that floating rate goes up, then your defeasance actually will come down. So there's actually some benefits to doing yield maintenance, but most folks would rather just be a prepayment or a pay down. So it's typically like 3, 2, 1. So over 3, 2, and 1 year. So over 3 years, that minimizes. So if you go to trade your asset after 2 years, they're going to ding you for essentially 2% on your exit fee. Whereas if you hold it for 3 years or past 3 years, then you wouldn't be subject to any prepayment penalty. And then 2, self-managed versus professional management. If you're local, on the ground, if you're also working a W-2, it's going to be very tough to manage your asset, especially if it's more than 5 to 10 units. Now, some can make it happen, but others usually put their faith in a third-party property management firm. Now, for units that are 50 units and below, that has been very tough to find good quality management. Typically, they like to gobble up as many different assets as possible and then put 1 or 2 property managers on several different assets, therefore spreading them too thin, and then there goes your profits and there goes your expenses go up, your rents go down, vacancy goes up, and then guess who has to pay the mortgage? So it's very key to, as we talked about earlier, about finding the key players that you want to team up with. And if you go the third-party management route, it's always good to vet 2 or 3, just like you're vetting your lenders, your brokers, anybody else that you're teaming up with that is a third party on this deal. I would always suggest, if you can't manage it yourself, then find a good property manager that specializes in that asset class and has other properties in the area. And I'd be happy to refer you to any property management folks in the North Carolina and South Carolina, as well as Virginia markets. Number 3, areas of due diligence. I referenced a lot of the environmental issues that you run into. Also, these third parties are very backed up right now. So when you go to put an LOI in and they're saying, 30 to 40 days on your DD period, you want to make sure you get your third parties out there so that you can inspect the property, make sure there's no issues, so that once your money goes hard after that 30 days, that you feel comfortable in doing so. Or else you can have, I've seen where some have an early access agreement. So before you execute the contract, typically a lot of sellers will ask for hard money day one. Well, I, a lot like you, don't want to leave a lot of money to risk, because as soon as that contract gets signed by both parties, your money is hard. So I want to make sure you're doing as much due diligence up front to make sure nothing happens during that time frame. So you want to get the PCA inspection is typically an all unit inspection. They're going to not only reference the exterior condition of the property, roofs, windows, siding. If there's any settling, you'll see kind of a stair step crack in brick. That means there's settling going on in the ground, and you might need to get a structural engineer out there. Okay, well, who's paying that? Well, guess what? You want to buy the property, you got to pay to play. So you got to pay for all these things and make sure you're checking all these boxes so you put yourself in the most probable position to get the deal done. Because not only is the lender going to want this information because they need to feel comfortable, but also you need to feel comfortable before investing a very large sum of money into an asset that you want to make sure is going to produce a nice stream of income for you. Hence, number 4, earnest money, due diligence, contingencies, closing. So you're going to typically, with timeframes right now, you see 30-day DD and a 30-day close. With lenders being backed up, typically folks are putting in a finance contingency, but in a competitive environment, you know, if you're running say you have a deal that you put an offer in that's a call for offers, there's going to be multiple different buyers. Well, to put yourself above the rest that don't have that finance contingency, typically I like to instruct my clients to bake in a little more time. Or if you say 30 days, then add another 15 days and say, if you put, say, 20 grand down, then add another 5 to 10 grand to add another 15 days. That way it buys you enough time and your third parties enough time, as well as your lender enough time to know if this is going to be a good deal, if it's going to work. Due diligence fees. So we see that a lot with residential, you know, single family home purchases. Now you see it a lot, which you can say hard money or due diligence fee, this kind of synopsis. Typically that's paid or goes hard or becomes non-refundable at the time of contract. Contingencies, we spoke about finance contingency. There's also, most folks will do a title, environmental, and then any other issues. So if say, the seller default is another one. So if the seller came back, they essentially let all their property, all the tenants move out, and they essentially took the property off the market or did something to essentially prohibit you from closing, then that would get all your earnest money back. If there's an environmental issue that he didn't properly disclose, or the broker didn't properly disclose, and it's affecting your financing or affecting your probability of closing the deal, then you get your money back. Now, if it's something like title, you're going to know that when you do your title search through your closing attorney. In North Carolina, you need to have a closing attorney to close the deal. They'll typically work with a title insurance company to make sure they run title and that you have clear title to move forward. And then closing. So closing attorneys are completely inundated. You've got lenders that are completely inundated because everybody's trying to refinance or close before these rates continue to go up. So making sure I like to keep kind of a contract date or crucial date time frame on all my calendars so that you know when things are happening and when your due dates are going to occur, so that you can not only let yourself know, but also let your whole team know. So that's lender, that's your banker, lender, your property manager, because they're going to want to be able to transition from the former owner to your new ownership and understand the new processes going forward, so they can get notices out to all the tenants to let them know where they're paying their rent now. Who do I listen to? Who do I call when I have issues? Because the last thing you want to do is not have a smooth transition. One of the tenants pays the former seller, and then they have a leak, and then all of a sudden you have a big old problem on your table, and you're not even collecting their rent. But there's other options where you can see where folks will push out closing, whether that's due to environmental issues or any other contingencies that popped up. We're seeing that now more than ever, especially with these volatile markets, because they're needing to add more time for appraisals to get back, third parties to get back, so that the lender can have all the information at their fingertips to provide a commitment letter for you to get the thing closed. On to the next slide, please, Randy.
Richard Mercado, check your chat message.
So just to kind of bring it all together. So one, like I said, identifying the property that you want to get into, figuring out the size of what you can afford, and then what's going to be the best fit after you put together your team in place. Negotiating the deal. So like I said, terms, price are always important. The shorter the time frames, the more competitive you're going to be. If they have an asking price, we've seen it a lot right now with deals trading or pricing softening by 5 to 10%. So if you can be within 5 to 10% of the strike price of what they're looking to get, and then cut down your time frames, that'll put you not only in a good negotiating position, because if you come in right at their asking price, that doesn't leave a lot of negotiating power for yourself. You always want to start with, you don't want to be rude, for lack of a better term, but you want to be in the ballpark, or else they won't even show the offer to the seller. So you want to be competitive. If you can't get there on price, then shorten up your time frames, wipe off the contingencies, do your due diligence up front before negotiating the deal so you know exactly what you're getting into, and then also making sure your closing attorney, your lender, your property manager is all on board and ready to go as soon as you say, give them the green light. So once you go under contract, that's when the real fun begins. That's when you start the DD clock. So that's when you get to do whatever you didn't have a chance to do prior to going under contract. This is your opportunity to get your third parties out there, get the appraisal out there, get any sort of property condition report done, get the inspection done, making sure you know exactly what you're getting into, because you don't want any surprises. Problems don't kill deals, surprises do. So if you can get ahead of those, typically good brokers can fix any problems that you give them ahead of time, but surprises at the last minute are not fun for you, for me, or the seller to deal with, and it can cause serious friction in the deal, and anything to avoid that will make your life, my life, and everybody else's life a lot easier. Closing table. So like I said, making sure the closing attorney has a date ready to go. You want to typically give lender, title at least 2 weeks notice at a minimum, because they are going to, like I said, they're very busy right now. You want to get ahead of the curve so that if you need to push out closing, you know ahead of time, and you can give that seller enough heads up so that he's not pissed off once you get to closing and say, oh, I can't close right now. Well, there's nothing a seller hates more than to hear those words. So anything you can do to make sure everything can be a smooth closing, make sure you do so, making sure your whole team, I typically send out a group email letting them know timeframes, when our potential closing date is, if there's any other information the bank needs, if there's any other information the attorney needs, and so on and so forth to get the deal done so that you have the highest probability of getting it across the goal line. And next slide, please. So I wanted to give you an example. Scott and I are working on a small deal down in Randleman, North Carolina. Most of you probably know that they just got approved for the huge Toyota mega site to go about 7 miles from this asset. But just wanted to give you kind of an example of what is out there, what to look for, and kind of examples of how deals are set up and how we underwrite deals. So for instance, this one's, we want to look at location. We also want to see what are the key drivers in a given market. So this is close to downtown. Like I referenced, this is right near the new job growth, huge economic driver that you're all looking for that will drive rents and drive property values. There's also an opportunity to push rents completing the value add that the seller has started. And then also just due to the expansion and urban sprawl of the Greensboro market, being able to get into not only probably the top 5 market in the Carolinas. Given on a typical day, it's usually Raleigh or Charlotte, and then it's Winston, Greensboro, and then Wilmington. Wilmington's probably in the top 3 based upon their rent growth. But steady Eddie, very good market is Winston and Greensboro, part of the triad. So this would be, for lenders' concerns, they look at this as a Greensboro asset. And why is that important? Well, as a lender, they look very favorable on Greensboro. So you can get up to 80% LTV. So you only have to put 20% down. Therefore, you can push your rents quite a bit. Now, for this asset, being that it's a mixed property, you've got a motel as well as 5 mobile home parks. You're going to be converting it over to a long-term, more of an apartment deal. Then your debt is going to be a little bit different. That's where, reaching out to a good lender, figuring out the best product for this asset class to make sure that you can get the most leverage possible and also help with your returns, and also going back to that cash on cash number. So for instance, the price on this, it's 31 units. We've got a price at 1.6 million. Due to the varying different asset classes within this same opportunity, we're only able to get 70% leverage. So you need to come with 480 grand. So your loan amount is going to be 1.12. It's going to be a new loan. So price per door is just under 52 grand per door. Your rentable square footage just under 12,000. Price per square foot is 135. This was originally built in 1945, but was renovated in 2018. And this sits on 6.83 acres. And why is that important? Well, after this mega site is built, this could be an opportunity to redevelop it into a bigger asset, especially when developers come calling to you and say, well, what do you want for not only your property, but also your land value? So having a nice piece of acreage that, once again, making sure there's no environmental issues, knowing what you're zoning for, and also being able to reach out to the city and local municipalities to figure out if you did and wanted to add more density to this spot, what are you able to do, and making sure that you not only reach out to those folks, but also sit down and meet with those guys. So case in point, if you do decide to have more of a covered land play and build more density on this site, then you can put them in your back pocket. So with that, based upon our pricing and the numbers, if you guys are interested, I'd be happy to provide more information at T12 and current rent roll on this asset. But you're looking at a cap rate of a 9.9, close to 10% cap, which in this market is very hard to find in North Carolina markets. So you're looking at pro forma cap rate of 12.25%. So your total return is going to be about 23% at 108,000. And then pro forma total is about 145,000. But with that, that kind of gives you a breakdown of what your cost outlay is, what you're looking for as far as lending, how much you need to put down, how many units it's going to give you, and then also what your returns are going to be. So when your, say, GP or LP or other investors ask, what's our returns? Well, here you go. But if you wouldn't mind, Randall, if you wanted to unmute Scott, I'll let him add some more flavor to this deal as well.
I'll make him a co-host, Randall.
Okay, yeah. There you go, Scott.
Cool. All right. Can y'all hear me?
Yeah, we can hear you.
Awesome. Yeah. So a couple of things that this deal really kind of has, and it's an awesome deal really for investors like ourselves that try and figure out ways to really make this one work. This particular seller is willing to, help out as far as down payments and things like that, do some seller financing. What this picture doesn't show us is less than a mile down the road is where they're installing the sewer systems and water lines for all the development that is going on that main road, going to the mega site that Ryan was just talking about. So when it comes to some of these deals, the entry number that we're looking at, the down payment number to get started, is definitely flexible. This deal as well as another one that I also put up on. So by the way, I put all these deals that we do onto the NC Rio website. So you guys can search for the commercial properties, and everything that we have goes in there. But this deal, there was a $5 million deal that just went on that the down payment was only $15,000. So definitely negotiable, something that you guys can talk to this seller about and look for an opportunity to, make a deal beyond just the dollars and cents that are up front. Beyond that, there's also room to add rents by increasing the number of units that are for rent. There's 3 units that are not being utilized at this time. Just lots of opportunities on this one, and I'd be happy to kind of go in more detail with anybody that'd like to sit down and talk about it.
Well, perfect. Thank you, Scott.
Yep.
And then next slide, and then I guess we can open it up for questions if anybody has questions, but that's all I have for you guys. There's mine and Scott's contact info if you guys have any other further questions.
And by the way, y'all, Scott is our member and he's at meetings a lot. And Scott, I had no idea you were a broker as well with this group. So
I was getting ready to say from the photos that you guys posted, multifamily brokerage has put some age on y'all. You know, Ryan, you've got some gray in your beard there. It looks much younger in your photos. So
Yeah, it's turbulent times out there, like I said.
yeah, Ryan, you look like about 14 in that photo.
oh
I was
man.
taken back in 2018 when I first got into the business, so it's fun, rewarding business, but it'll definitely test you in multiple different ways. But if it was easy, everybody would do it.
Ain't that the truth? It's just like investing in real estate. If it's easy, everybody would do it.
Facts.
Anyone have any questions?
Yeah, I've kind of been monitoring Brian. Scott's been pretty on the ball with answering questions in here
Yeah.
before I could. So that's great having a co-moderator that Ryan brought that knows the business. So that's an excellent point. Someone did ask, what is the average amount percentage for due diligence in this market for multifamily currently?
Yeah, good question. I would say it depends on the size of the asset. For a smaller deal, call it 50 units and below. It all depends on your lender, what they're going to require. But typically what I see is I would factor in a good 15 grand for, now if you need to go and do phase 1, phase 2 survey, that can be more expensive, but I typically would at least set aside 10 to 20 grand for that expense.
Hey guys, this is Gregory Company. I do have a question. You were mentioning how in certain geographies, lenders would potentially provide a higher LTV. Is there a way that you would recommend positioning that? So let's say you're working with a lender in a totally different state. They lend in the area that you're looking. However, they may not be as well aware of what's happening in that local market. Is there a way that you would suggest for us as investors to sort of encourage a broker to maybe increase their LTV based on the market conditions and the location?
Yeah, absolutely. There is oftentimes where I get to battle with appraisers that don't know the market, don't know the essential, economic drivers that's going to help not only make money, but push the value of current assets. So for instance, like that deal in Eden that is just north of Greensboro, well, that should be considered the triad, since it's only about 45 minutes north of Greensboro. They were, at first, the bank was able to give them 80%, but then they knocked it down to 75% because it goes back to the debt coverage ratio. So that's the amount of debt you need based upon the amount of income or net NOI you're bringing in. So it all goes back to the numbers. But when it comes to location and being able to kind of massage different appraisers and lenders, is making sure you do your homework and speak to things like the mega site for Toyota. Or for instance, in Eden, they're converting that Anheuser-Busch site into a Purina dog chow manufacturing plant that's going to bring in 5,000 jobs, and the average salary is about $140,000. And then looking at what's trading around them, and then what other debt sources are available to you. So for instance, like a property like in Charlotte, where you're going, call it 45, anywhere between, call it an hour radius, should be considered Charlotte MSA. And if you're going to be able to benefit from the urban sprawl of these growing markets like Raleigh, Charlotte, Greensboro, Winston, Wilmington, being in that, call it 30 minutes to an hour kind of rim around that, I would go back on the lender all day long about the ability to get better leverage. And being able to tell that story and hiring a good broker that knows their stuff will go to bat for you and make sure that when they do come back and say, oh, this is only the leverage I can get, then making sure they understand, because sometimes it's a function of underwriting. And I always like to have the lender and I go back and forth on the underwriting. Let's review your numbers. Let's review what your pro forma is. Let's review your expenses, and let's find out where we can chop this thing down to not only increase your NOI, but increase your debt coverage ratio so that you can get more leverage on a certain deal.
Awesome. Thank you. That's actually really helpful.
Yeah, we got one more question. Where did it go? Everybody's asking for the slides. What's the most challenging aspect of commercial real estate brokerage?
Oh, man.
And your answer might lead me into the next question. So depending on how you answer this question, I might ask my question.
I would say right now, it's the gap between sellers' expectations and buyers' expectations. And then couple that with the lending environment that we're in right now of where pricing was, call it 3 months ago, and where pricing is now, and the ability to secure certain debt. For instance, we have a deal down in Greenville that I just got retraded on today, and they're basing it on because the debt that they were penciling in for their underwriting when they first went under on contract on the deal has now moved 270 basis points up. So therefore, they're syndicators, so therefore they have duties to their investors about returns that they've already quote unquote promised them on this deal, and now they can't get that. So now they're trying to come back on price, and then they came back on not only termites, but also polybutylene piping, which for those who are not familiar with it, it's an 80s product that they put in a lot of these buildings that has weakened joints and that causes a lot of leaks and a lot of water damage. And then termites, as I'm sure you probably all well know, can have wood destroying insects that can definitely affect the interior and the future deferred maintenance of a property. So when you have multiple different buildings with multiple different issues, and you didn't factor that into your cost when you're doing CapEx, and the fact that you have a certain amount of number you set aside for those CapEx expense, and then that number goes up, and then the fact that they can't get the lending that they thought they're going to get, because they were going to get fixed rate bridge loan, now they can't get that, now it's going to be a floating rate, therefore their rate's skyrocketing. So they're saying, oh, they're going to tell the seller that it's the seller's fault they didn't lock in their rates 30 days ago, and that they didn't have an opportunity to get into the property and do a proper inspection of not only the polybutylene, but also the wood destroying insects. So it all goes back to a lot of different mitigating factors. As a broker, I deal with, I have people hand me, issues every day. They're like, Ryan, figure it out because we're about to blow up the deal. There's got to be a different way to do it. But I love problem solving. That's why I'm a broker. That's why I enjoy what I do, because people hand me their issues and I solve them. So anytime you run into certain issues, you want to make sure you've got a damn good broker, excuse my French, that can not only mitigate the troubling waters, but also go to bat for you to not only get, say, if you renegotiate on the buy side, that you actually present it in a very clear form so that not only the seller understands, but also, say, the seller's broker understands, so that you guys can have a solid conversation where everybody can find, common ground, and then get to a point where you guys can agree on something and move forward and get past any issues that you might have. So I would say the biggest issue, the hardest thing I do is finding that common ground and being able to not only deal with a lot of personalities and a lot of headstrong individuals, but at the end of the day, it comes down to numbers. It comes down to dollars and cents. And if you can make things interesting, find creative ways to get things done, especially in a market like this where the market is moving quite a bit, that'll only help you get across the goal line and heighten your probability, and therefore building more rapport, because at the end of the day, this is a very small group of folks. If you burn a bridge with a seller, you might run into that seller again. So be careful of, not only your past, but also your present going forward. And that if you want to build a strong business model and a strong reputation in this market, you want to make sure you're handling deals appropriately, you have the right team in place, and that you're closing on a very high level so that people want to do business with you, because they don't have to do business with you, but they want to do business with you.
I'm glad you answered that, Ryan, because that led me into my question. So as an investor, right, how do you get past, for instance, Ryan and Scott's pro forma because from my understanding, pro forma is just an assumption of how Ryan and Scott would run the deal, right? So the issue that I'm running into is in self-storage is coming across these brokers that are really overinflating the pro forma, saying, hey, this is where we can get, this is what we think can happen. And I do it every day, right? I'm on my fourth self-storage facility. And sometimes how, as an investor, would you recommend getting over that pro forma for the overinflation?
Yeah, typically when, I deal with, you want to be when I was going through training, it's all about not only being competitive, but you got to be able to substantiate whatever you're putting in a package. So if I say, you're going to have, 20% rent growth in FY1, well, most people would be like, Ryan, go pound sand. How the heck did you get to that number? Now, being able to prove that is by showing, okay, this is where it comes back to how you get into the deal, how do you make money, and then how did you get to that pro forma number? So for instance, for this, it's a very heavy value add opportunity. You can push rents 50 to 60%, especially if it's got some poor management. There's some management efficiencies. There's also value add opportunity. There's below market rents as it currently stands. And then there's probably an opportunity to, maybe there's a way to recoup some of the money through, doing a sub-metering or bill back to the tenants, or if they're running their expenses too high, where property management is spending, $1,200 a unit on payroll, where you really only need one person and one maintenance guy running the asset, and therefore it should be baked into the management fee, which should be, typically depending on what the size, for smaller assets between 50 units and below should be 8 to 10%. Bigger assets, you're going to be in that 3 to 5% range. But honestly, Randall, I typically like to have, a call like this with a buyer or seller, and I run through my underwriting and I show them how I got from point A to point B and show them how to do it themselves. Now, you're always going to have people say, you're full of what, but at the end of the day, making sure you can paint that picture for them in a very clear, concise manner. More often than not, if people see the numbers and understand the process, it's hard to argue with that at the end of the day. So I would recommend chatting with, setting up a Zoom call or WebEx call, or if you want to, typically most folks don't like to share their underwriting models. What I typically do is take a screenshot of it so that you're not sharing any proprietary information, but at least it's a way for you to discuss the fine-tuned points of how did you arrive at that number? Okay, well, here it is. Let's set up a call and walk through it.
Gotcha. Well, Ryan and Scott, thank you for your time. It is.
I've got one more, guys, if you don't mind. I know we're
Sure.
probably pushing it.
We're pushing for time, but go ahead, Greg.
Yeah, sorry, just real quick. So in today's market, with all the changes to the rates and whatnot, we typically would expect prices to start coming down to sort of balance things out. What's the other leverage play for an investor, right? As the rates go up and that changes the numbers for everyone, what's the other counterbalance that we can maybe focus on in negotiating with sellers or working with brokers to sort of figure out how to make our numbers work where they might have 2 months ago and now they don't because of the rate hikes?
Right. So I'm glad you brought that up. So this is the time where you have to get very creative. So whether that's seller financing, having the seller hold a note for a certain amount of time,
Yep.
Maybe it's, call it interest only for 6 to 12 months. If there's like a value add, or if there's like a mobile home park that you have to fix up a certain amount of pads or units, then that frees up the cash flow for you to get in there, say spend 5 to 10 grand to get those units up so you can get those leased up. Typically it all comes down to the desire to get it closed. If the seller is motivated, then they will work with you and figure out a way to get it done. Typically they like money. They also don't like to pay taxes. So if you can defer your taxes, now everybody likes to use 1031 exchanges because they're a beautiful instrument to defer your taxes and increase your cash flow and put it back into another deal or leverage up into another deal. So I would look at a lot of different ways. Maybe the seller stays on and manages the asset for you, or, seller financing, or maybe there's a way you come in as you guys are partners. Maybe, there's amount of time where, you come in as a GP, you pay him a lump sum of cash to give you a certain amount of ownership. Typically it's, 40 or 50 or 60 or even 70-30, depending on how you want to structure it. But finding different creative ways to get things done, and that's where, a broker or a lender or someone else on your team can help you kind of navigate those waters. But I would say that it's all about finding, what does the seller want? What is he after? And where are some things that we can kind of find some common ground on, where we can get this deal across the goal line. So I would start there, but at the end of the day, it can be, maybe there's a piece of land or something else that's nearby, or maybe packaging a couple of deals that he has, doing your research to know what that seller owns, so that you could say, well, if you don't want to sell this, what about packaging these two together and this one? Do you own that land? Or there's a property down in Jacksonville that has a cell phone tower. Being able to negotiate the rights to that so that you can sell the rights for the usage of that tower. I would just encourage you to kind of figure out what the pressure points are for the seller and figure out ways to navigate those waters, but it's going to be on a deal by deal basis.
Got it. Thank you, guys.
Absolutely.
Awesome. All right. Well, hey, again, like I said, Ryan and Scott, their information is here. Be sure to take down their phone number and their emails. Jump on their distro list. If you're interested in commercial real estate, multifamily, mobile home parks, in and around, the Triangle area, I'm sure they're a great asset to have in your Rolodex. But other than that, we don't have any more questions. We kind of went over time. And again, Ryan and Scott, thank you for taking the time out of your evening to share both your deal and your knowledge with the group. And look forward to having you or Scott in more of these meetings to add value to this group. If there's no questions, I'm going to stop sharing, and I'm going to kind of release everybody from the Zoom meeting.
Hey, before everybody
Well,
goes,
thanks again for the time.
I just want you all to know, I bring our outlook for the different asset classes to every meeting. So if anybody wants to stop by and pick up the books about different asset classes, I always have those books at the meeting for you guys, so you guys can grab some and learn more about your asset classes.
Absolutely. Cool. Thanks. All right, everybody. If you got nothing else, you guys have a good night. Enjoy the rest of your week. And we'll talk to you soon.
Thanks, everyone.
Thanks, Ryan.
Night, everyone. Thanks, Ryan. Thanks, Scott.
Yeah, have a good night.
Have a nice evening.